Larry, would you, I feel like you're not the guy who would be rooting for rate cuts at this point, but you know about real rates and how restrictive we're getting up to 2009 levels here.
Well, I certainly don't think they're going to be cutting this year. I actually think they're more likely to increase this year. And the president is correct when he says that if inflation comes down next year, the Fed will cut. I'm not as optimistic as he is about inflation coming down, but obviously, if it does, they will cut rates.
So you do think, okay, so what are we talking about inflation coming down to? We're about to get the CPI report later this week. And Williams, I mean, if we kind of back up from what he's talking about and say the Fed funds rate is now, I'm just going to round up 5.5, then the inflation rate has to be below 3.5 at least. You think that's where we're going to be this time next year?
I think the answer is we will see. The most important thing that's happening in the economy is the solid wage increases. They are going to continue. Earlier story mentioned that they're probably going to become more widespread. We now have sort of a standard 5% or higher contract settlement. Usually that's front-loaded, which means you're going to have more cost pressures in the short run. The other thing I think that's important is that no matter what the Fed does, the long end of the curve is going to continue to rise in rates. By the end of 2024, I would imagine the inversion will be over, maybe well before then, and we're going to see the longer rates up in the 5% area. And that means that money is going to be hard to come by. All money is going to get more expensive. And it's the government deficit that will drive that.
Wow. And that's obviously the Bill Ackman argument, Steve, that, you know, he thinks the 30 years going to 5.5%. So there's this split between people who think rates are, and that part is, are going to stay, you know, much higher for longer, kind of normalized like they did a couple decades ago. And those who think we could go back to something more like the 2010s.
Yeah, I mean, there's an idea out there that the Fed will be not going back to zero. I think there are people who would applaud the Fed not going back to zero. And I think there's an idea that the curve is going to uninvert. What is the right way? Revert? What is? Somebody give me the verb there. You can write in on Twitter. I'll check it out.
It's going to flatten. How about that?
De-uninvert, flatten, or actually go back. The long end will rise in any event. But I just want to be clear about what Williams is saying, because the Fed looks at things in a different way, and I think Larry knows that. They look at real rates. What if I told you that the Fed plans to cut its nominal rate, but there's a way to measure it that shows real rates actually increase? What I'm showing you there now is if you base that on their projection for PCE next year versus their projection for their nominal rate this year and next year, it goes down by 0.3 while they cut 100 basis points. Now notice, 2.4% real this year, 2.1 next year. And that is relative to what they believe the long run rate should be, so 0.5.
This is the real question. People think, well, what is the kind of normal real interest rate? And they think it should only be 0.5%? 0.5
point above the inflation rate. So
wow.
just to be clear there.
We're way above that right now.
They are restrictive in their mind, okay? Now, Larry may have a thought on the right deflator to use there, whatever it should be. But let me just point out that if you use their headline PCE number, they actually get, core PCE number, they actually get more restrictive next year relative to their core PCE for this year. So
even if they stop tightening,
the markets, it's one of those things that I always wonder, you can fool some of the people some of the time in the sense that let's all buy stocks because the Fed is cutting. In the Fed's mind, it is not really getting that much less restrictive.
Larry?
I think that's right. I think that's one of the reasons they probably won't cut. And if the labor market continues the way it will, or the way it is, then I think that, in fact, those inflation numbers are likely to go up.
So, in other words, Larry, you would take cuts off the table, not philosophically, but just practically. You just don't think the inflation rate's coming down that much next year.
That's correct. And I think we're going to see actually a little more upward pressure. We've already seen the turn in commodity prices and oil. That's a small part of the total inflation, but it works its way through the system. And again, it's labor, labor, labor. And there is no real softness as far as wage negotiations go. One of the things about the unemployment report, or the employment report, that isn't getting a lot of mention is that we are now up above where we were in 2019 in terms of participation by prime age individuals, 25 to 55. Not that there's anything wrong with people my age, but that's where the growth in effective labor supply has to be. And we're already fully employed there.